Is that what we should take away?
Well, I think what you see there is what you've been hearing from members of the FOMC, which is the outlook has brightened considerably on the back of the vaccinations and substantial fiscal support, that additional savings that consumers have accumulated. So brighter outlook. But of course, our monetary policy forward guidance is premised on outcomes, not the outlook. And so it is going to be some time before both employment and inflation have achieved the kinds of outcomes that are in that forward guidance.
How long is some time for you in terms of your own forecasts?
Well, I think what's really important here, Sarah, is that because we are basing our forward guidance on actual realized outcomes on inflation, actual realized outcomes on employment, that is going to depend on how rapidly we see improvement. So what you see in the SEP, the forecast, is considerably better outcomes both on growth as well as on employment and inflation. But again, that's an outlook. We're going to have to actually see that in the data. When you look at the data, we are still far from our maximum employment goal. For instance, you take into account people who have dropped out of the labor force, as well as the decline in employment. And, we're over 9 million jobs short of where we were pre-COVID. If you take into account that reduction in the participation rate, the unemployment rate looks more like 9% than it does like the headline unemployment rate. So, in that sense, we've got some distance to go before those outcomes are achieved.
And inflation is the other piece of this, of course, and the big debate right now in the market. Chair Powell has said that he expects it to be transitory, along with some of the other Fed members. Wondering what your call is on that as far as the upcoming rise in inflation that we're expecting.
Yeah, well, there are some unique factors this year that could be expected to push inflation above 2% this year. Obviously, there are those base effects that are going to drop out. So we'll see inflation on a 12-month basis briefly jumping up in April and May. But then later in the year, as the economy opens back up and we see that pent-up consumption coming into the services sector and more broadly in the economy, we could expect to see some bottlenecks in supply chains that also might contribute to some increase in inflation for a period of time. But it's really important to recognize that those are transitory. And following those transitory pressures associated with reopening, it's more likely that the entrenched inflation dynamics that we've seen for well over a decade will take over, then that there will be a sustained surge in inflation for a persistent period.
I wanted to ask Governor Brainard about some of the things, the headline points from Jamie Dimon's annual letter today. And one quote in particular stood out on QE, saying, quote, "Much of the money supply made a round trip because of new liquidity rules. It ended up back as deposits at the Fed, not as loans." And essentially his argument, while bullish on the outlook for the economy because of other factors like the fiscal stimulus, was that QE doesn't really do anything. What's your take on that?
Well, I don't want to speak specifically to any particular letter, but let me just say more broadly, if you look at financial conditions, they are very accommodative today, which is very much in line with the forward guidance on our asset purchases and our rate policy as well. And they are clearly supporting a stronger recovery. If you look at the data that's out today on consumer credit, also really strong there. So I would say that, we are seeing the kinds of financial conditions broadly across the financial markets that are very consistent with supporting the recovery, with supporting the flow of credit to businesses and to households. And I think that is very much in line with the goals of our overall monetary policy stance.
Shepard Smith here. Thanks for watching CNBC on YouTube.